Good morning, everyone. I'm your host Eric for today's Forex Focus, bringing you the critical insights you need to trade the world's most liquid currency pairs amid central bank volatility. Today, we are zeroing in on two must-watch pairs for every macro trader: Euro to US dollar and Pound sterling to US dollar. We'll break down live entry zones, proven trading techniques, clear support and resistance levels, and the non-negotiable risk management rules you need to stay safe and profitable when markets get choppy. Let's dive right in. First, let's set the stage. The Forex market is facing heightened uncertainty right now, driven by conflicting signals from three major central banks: the US Federal Reserve, the European Central Bank, and the Bank of England. The Fed is stuck between keeping rates high to fight inflation and hinting at potential cuts as growth slows. The ECB is holding steady, even as the Eurozone struggles with stagnant GDP and high energy costs. And the BOE? It's grappling with inflation above 3.8%, keeping rates higher than both the Fed and ECB, which is giving some support to the British pound. This policy divergence is key to today's price action, so keep that in mind as we break down each pair. Let's start with Euro to US dollar, the most traded currency pair in the world, making up about 28% of daily Forex volume. As of right now, Euro to US dollar is trading near 1.1735. That's in the middle of a short-term corrective pullback, after rallying from 1.1650 to 1.1790 over the past week. Right now, the intraday bias is softly bearish. Sellers are gaining a little traction, but it's not a strong downward trend yet. The pair's intraday high so far is 1.1742, and the low is 1.1711. So, it's consolidating as traders take profits and wait for the next Fed and ECB moves. To trade Euro to US dollar effectively today, you need to know the key support and resistance levels. These are not random numbers. They're based on historical price action, institutional order flow, and technical analysis, so they're reliable zones where sentiment shifts. Let's start with resistance, which is where we'll be looking for short opportunities. Near-term overhead resistance is firm between 1.1750 and 1.1765. This zone has been a big barrier over the past 48 hours. Why? Well, 1.1750 is a round number. Traders love to take profits or short at round numbers. Plus, this zone lines up with the 50-period moving average on the 1-hour chart, which acts as dynamic resistance. For intraday traders, this 1.1750 to 1.1765 zone is your ideal selling spot. It's where bullish momentum is likely to fade, and bears will step in. Above that, we have a secondary resistance level at 1.1790. That's the recent swing high, and it's a hard supply ceiling. A break above 1.1790 would mean the upward trend is continuing, but given the current bearish intraday bias and Fed uncertainty, that's unlikely today. In fact, any rally toward 1.1790 is a chance to add to short positions. If you see clear bearish rejection, that is point one. Quick note: resistance levels aren't set in stone. They can shift a little based on intraday price action and volume. For example, if Euro to US dollar rallies to 1.1760 and you see a long upper wick on the 15-minute chart, that's bearish rejection. The resistance zone might effectively drop to 1.1755 to 1.1760. So, stay flexible. Don't stick rigidly to the numbers. Watch the price action too. Now, let's talk support, where we might look for long opportunities. Though remember, the intraday bias is bearish, so long should be cautious. Immediate support is between 1.1700 and 1.1715. This zone has been a strong floor during the current pullback. It's supported by the 200-period moving average on the 1-hour chart, which is a widely followed indicator for trend direction. 1.1700 is another round number, so it attracts both retail and institutional buyers who think the euro is undervalued short-term. If this support breaks, we could see a deeper correction. The critical major support level today is 1.1670. That level hasn't been breached in over 2 weeks. It lines up with the recent swing low and the 100-period moving average on the daily chart. A break below 1.1670 would signal a big shift in sentiment, more downside to 1.1650 or even 1.1600. But given the ECB's steady stance and Fed pressure to cut rates, 1.1670 is likely to hold. So, if you see bullish reversal signals there, it's an attractive long entry. Now, let's get to the trading technique for Euro to US dollar today. Sell the rips into resistance. This is a proven strategy for corrective markets. Rallies into resistance are likely to fail, giving you high probability short entries. Here's how to execute it step by step. 4 short entries. Wait for the price to rally into that 1.1750 to 1.1765 resistance zone. Check the 1 hour or 15-minute chart. Don't jump in right away. Wait for clear bearish candle rejection. What's that? Look for long upper wicks, bearish engulfing patterns, or a few red candles in a row after the price touches resistance. Those patterns mean sellers are stepping in, confirming the resistance is holding. Once you see that rejection, enter the short position. To protect your capital, place your stop loss above 1.1795, just above that secondary resistance at 1.1790. This filters out fake breakouts, those short spikes above resistance that quickly reverse. Placing the stop loss at 1.1795 instead of 1.1790 gives you a small buffer, so you don't get stopped out by market noise. For take profit, we use a 2-tier approach. First target, 1.1715. That's the upper end of the immediate support zone. Depending on where you entered in the 1.1750 to 1.1765 zone, that's 35 to 50 pips profit. Once the price hits that first target, move your stop loss to break even, your entry price. That way, you have no risk left. Then, hold the rest of the trade for the second target, 1.1670, the critical support. That's an extra 45 pips, so total potential profit is 80 to 95 pips per trade if you prefer long positions, and again, we emphasize prefer. Because the bias is bearish, only buy deep dips at the 1.1700 support zone. Do not chase bullish moves in the middle of the range, between 1.1715 and 1.1750. Those moves are short-lived and will likely lead to losses. Wait for the price to hit 1.1700 to 1.1715, then look for bullish reversal signals, hammer candles, bullish engulfing, or a strong bounce with high volume. Those signals mean buyers are stepping in. When you enter a long position there, place your stop loss below 1.1665, just below the 1.1670 critical support. That limits your losses if the support breaks. Take profit targets, 1.1750, the lower end of resistance, 435 to 50 pips, and 1.1790, secondary resistance, 485 to 90 pips. Again, move your stop loss to break even once the first target hits. Patience is key here. Don't force a trade if the price doesn't reach these zones, or if there's no clear rejection or reversal. The best trades align with both technical levels and price action. Also, watch volume. Rejection at resistance with high volume is a much stronger signal than low volume, because it means institutional traders are involved. Now, let's shift to pound sterling to US dollar, known as cable to traders, named after the old undersea cables that transmitted exchange rates between London and New York. It's the second most traded pair, making up about 12% of daily Forex volume. Cable is sensitive to BOE Fed policy divergence, UK economic data, and even Brexit leftovers. Right now, pound sterling to US dollar is trading around 1.3525, with a neutral to mild bullish structure inside a clear daily range. Unlike Euro to US dollar, which is in a corrective pullback, pound sterling to US dollar has been trading in a well-defined range for the past 2 weeks. That's perfect for range trading, buying at support and selling at resistance. But because of the mild bullish bias, we favor buying controlled dips at support over selling at resistance, though both setups work if the price action confirms. Let's start with support for pound sterling to US dollar. Immediate support is 1.3470 to 1.3485, a strong institutional demand cluster. This zone has been a reliable floor during the range. It's supported by the 50-period moving average on the daily chart and lines up with a recent swing low. It's also just below 1.3500, a round number that attracts retail buyers. This zone has high volume, so it's a key spot where sentiment shifts from bearish to bullish. Below that, major support reinforcement is at 1.3440. That level hasn't been breached in over a month. It lines up with the 200-period moving average on the daily chart and the lower end of the current range. A break below 1.3440 would mean the range is breaking, and we could see a bearish trend. But with the Bow's hawkish stance, that's unlikely today. Still, if the Fed sounds more hawkish than expected, we might test this level, so keep an eye on it now. Resistance. Overhead resistance starts at 1.3555 to 1.3570. This has been a strong supply ceiling during the range. It's supported by the 100-period moving average on the 1-hour chart and a recent swing high. It's just below 1.3600, so it attracts profit-taking and short selling. A break above this zone could mean a break out of the range and more bullish momentum. Above that, the key swing high barrier is 1.3590, the upper end of the daily range. That's the highest cable has been in over a month. A break above 1.3590 confirms a bullish breakout, likely leading to 1.3620 or 1.3650. But given the range-bound nature, a breakout today is unlikely. Still, monitor it for bullish signs. The pound sterling to US dollar trading technique today is, buy the dips at support and sell heavy resistance rejections. Let's break down both long and short setups. 4 high probability longs. Focus on the 1.3470 to 1.3485 support zone. Wait for the price to dip there, then look for bullish reversal price action, hammer candles, bullish engulfing, or a strong bounce with high volume. Wait for confirmation. Don't buy just because the price hits support. Wait for it to turn higher. That's how you avoid fake dips. When you enter a long position here, place your stop loss below 1.3435, just below the 1.3440 major support. This limits losses if support fails and gives a buffer against market noise. Primary target, 1.3555, the lower end of resistance. That's 70 to 85 pips profit, depending on your entry. Secondary target, 1.3590, the swing high. That's an extra 35 pips, total 105 to 120 pips. Once the price hits 1.3555, move your stop loss to break even. That way, you can hold for the secondary target with no risk. If the price fails to reach 1.3590 and shows bearish rejection at 1.3570, close early to lock in profits. For short entries, focus on the 1.3570 to 1.3590 resistance zone. Wait for the price to rally there, then look for clear bearish rejection, long upper wicks, bearish engulfing, or consecutive red candles with high volume. Short entries are only valid if there's strong rejection. Don't short just because the price hits resistance. When you enter a short position here, place your stop loss above 1.3615, just above 1.3590. This filters out fake breakouts. Downside targets, 1.3520, current trading level, 450 to 70 pips, and 1.3485, upper end of support, 485 to 105 pips. Again, move stop loss to break even after the first target point. One key difference with pound sterling to US dollar. It's range bound, so you need to be more disciplined with entries and exits. Price will reverse at support and resistance, so don't expect a strong trend. Also, pound sterling to US dollar is more sensitive to UK economic data than euro to US dollar. Keep an eye on inflation or employment figures today. If a data release breaks the range, adjust your strategy to follow the new trend, don't fight it. Now, let's talk about the most important part, risk management. No matter which pair you trade, these 4 rules are non-negotiable. They'll protect your capital during volatile central bank sessions, and they're based on decades of trading experience. Rule 1. Reduce your standard position size ahead of Fed policy headlines. The Fed is the most influential central bank. Its announcements can cause extreme volatility. Even hints of policy shifts can lead to sudden spikes or whipsaws in euro to US dollar and pound sterling to US dollar. Today, with conflicting Fed expectations, volatility is higher than usual. Cut your position size by 50%. If you normally trade one standard lot, trade 0.5 lots today. Smaller positions means smaller losses if the market moves against you. This is discipline, not weakness. It keeps you in the game tomorrow. Also, avoid entering new trades 30 minutes before a Fed announcement. The market is chaotic then. Price moves are emotional, not technical. Wait for the market to stabilize, then look for high probability setups. Rule 2. Always use fixed stop losses on every trade. Unprotected trades are dangerous during macro news. For example, if you short euro to US dollar at 1.1750 without a stop loss, and the Fed surprises with a rate cut, the pair could rally to 1.1850, 100 pips lost in minutes, which could wipe out your account. Set stop losses based on technical levels, not arbitrary pips. For euro to US dollar shorts, stop above 1.1795. For pound sterling to US dollar longs, stop below 1.3435. Never move your stop loss further away to avoid being stopped out. That only leads to bigger losses. If your stop loss hits, accept it, re-evaluate, and move on. Rule 3. Move your stop loss to break even once your first target is reached. This eliminates all risk. Once the trade is in your favor and you've locked in a small profit, you can't lose money on it. For example, short EUR. The USD at 1.1755, first target 1.1715, stop loss 1.1795. When it hits 1.1715, move stop to 1.1755. If the market reverses, you break even. If it keeps going down, you hold for the second target. This is a simple but powerful rule that separates successful traders from losers. Rule 4. Avoid overtrading in the middle of the range. Overtrading is a big mistake, especially in range-bound markets. The best setups are at clear support and resistance, not in the middle, where price is unpredictable. For euro to US dollar, avoid the 1.1715 to 1.1750 range. Focus on 1.1750 to 1.1765, shorts, or 1.1700 to 1.1715, longs. For pound sterling to US dollar, skip the 1.3485 to 1.3555 middle. Stick to 1.3470 to 1.3485, longs, or 1.3555 to 1.3570, shorts. Set a daily limit, 2 to 3 trades per pair, and stick to it. Trading is about quality, not quantity. Let's recap today's key takeaways. Euro to US dollar is in a short-term corrective pullback with a soft bearish bias. Sell the rips at 1.1750 to 1.1765. Buy only deep dips at 1.1700 to 1.1715. Pound sterling to US dollar is range-bound with mild bullish bias. Buy dips at 1.3470 to 1.3485. Sell rejections at 1.3570 to 1.3590. Follow the risk management rules. Cut position size before Fed news. Use fixed stop losses. Move to break even at first target, and avoid overtrading. Remember, no strategy is perfect. There will be losing trades. The best traders accept losses, learn from them, and stay disciplined. Stay informed on central bank news and economic data. Markets change fast, and you need to adapt. That's it for today's Forex Focus. Stick to the levels, follow the rules, and trade with confidence. We'll be back tomorrow with the latest updates and setups. Until then, happy trading.